It was another wild session on Wall Street. Had a little something for the bulls and for the bears. Last night before we went to bed, we saw futures surging, so it gave us an indication that this morning could be a pretty powerful open. And of course, that followed yesterday's very strong rally. So there was some enthusiasm, but as the stock market finally opened this morning, then it started to fizzle just a little bit, and some of the sellers did creep into the system. Now, we did end up having a very good breadth day where we had 89% of the stocks closing in the green, but the vast majority of them were well off of their daily highs. That happened within just the first 5 or 10 minutes of the session. So we'll see where that takes us. We do have some very positive news happening after hours that I'm going to go through in tonight's video. So that could spur especially the NASDAQ along a little bit tomorrow morning. We'll also, of course, review our postures on the overall markets and on the individual sectors in tonight's video. And then I'm going to end with a trade application example known as a bear call spread on a stock that's been underperforming the rest of the market for quite some time. And the hope is that it will continue to do so here for the next month or so. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 18th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. And remember, at the bottom of the emails, you'll also see which stocks are giving you overbought and oversold cluster signals within the S&P 500. We're also heavy users of Twitter. If you're not doing so already, we'd encourage you to follow us. My handle is Brandon Van Zee. We really appreciate those of you that click like and retweet on these market outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you can see, we've got a lot of green on the screen once again. We actually saw that before I went to bed last night. Some of you might have seen my tweet. The futures were spiking. It might have been around like midnight East Coast time, maybe about 12:30, somewhere in that general vicinity. We had a very sharp ascent in the futures. And I said that our dreams are going to be made of green, and that did come through for us to a degree, although I must admit it felt a little bit underwhelming by the time the full day was done. And the reason for that is the futures were up as much as 2%, giving us the impression it was going to be a really robust day to the upside. Instead, we were kind of left with just more of a 1% move. So a little bit of a whimper. Nonetheless, hey, beggars can't be choosers in this market. If they're going to give us a green day, we'll take it however we can get it. So as you can see, despite a lot of stocks gapping higher to start the day and then spending the rest of the day kind of sliding, most of them still managed to close in the green. A few of the brighter greens that show up on our screen here. You can see Lockheed Martin was up about 8 or 9% on their earnings announcement. We've been talking about those defense contractors a bit more in these presentations, and of course also mentioned them here recently in my top-down trend trading classes as well. But Raytheon was up about 3.5%. Northrop Grumman was up about 6%. General Dynamics, a good dividend aristocrat there, up nearly 4%. L3 Harris up nearly 6%. So all of that was kind of in sympathy with Lockheed Martin. Naturally, when we're in kind of a wartime conditions like we are right now with Russia, Ukraine, and with the saber rattling going on over in North Korea, with China, Taiwan, these are heightened tensions that we find ourselves in. And therefore, a lot of those defense contractors are kind of in the sweet spot right now. Remember, what makes them somewhat unique is that they don't need a strong economy to do well, necessarily. Remember that they are generally paid directly from the U.S. government. And so while the government needs a strong economy to collect taxes, perhaps, it's not quite as direct as what you would find with most other sectors and industry groups that are out there. So real strong day there for Lockheed Martin. Also see a strong patch there for Target, up 5% today. That one was quite timely for us in our premium classes here at Market Scholars. Just yesterday afternoon, we reviewed a put selling trade on target, which of course is a bullish trade. So nice to see that one up a day later. We also see over here that Salesforce.com, ticker symbol CRM, was up over 4% today as a hedge fund announced a position in the company. I think it was Starboard Value, and they might be agitating for change moving forward, so that gave investors something to cheer. See a little bit of green here in the healthcare area. Cardinal Health has been sneaky strong this year. We talked about it a bit in my classes because, like General Dynamics, Cardinal Health is another dividend aristocrat. It doesn't get the press that maybe Coca-Cola and Procter & Gamble and McDonald's do. But Cardinal Health had kind of been in the doghouse for the last, let's call it 3 or 4 years or so. But all of a sudden here in 2022, it's been firming up on a relative basis while the rest of the stock market has been plunging lower. So keep your eyes on that one. We do have some strength out of the banks. In fact, that's been probably the most important bright spot here in the last 3 trading sessions or so. Remember, we just kicked off earnings week, or earnings season, I should say, last week. And the banks usually kind of kick us off. And JP Morgan's been up, I think, 3 days in a row. Pretty strong percentages, too, not just your average typical days. Bank of America was up nicely today, almost 4% there. Morgan Stanley kind of regained some. They were one of them that sold off last week, kind of bouncing back today, about 3% there. But a lot of the other financials, including some of the insurance companies like Berkshire Hathaway, doing real nice here today as well. Really, it's kind of hard to pick and choose, to be honest, because as you can see, the vast majority of these sectors do end up a bit more in green than in red. Where there is more concentrated levels of red, even that's kind of hard to pick out. I would say that the semiconductors are a bit more in the red, and we'll actually have a bit more to say about that in our trade application example a little bit later tonight. But you'll notice that Qualcomm was down, Intel was down, Micron was down, Broadcom was down. So that seemed to be an area that just couldn't quite get it together here today. Seemed like there was maybe a little bit more weakness in healthcare today than there had been previously. Johnson & Johnson reported their earnings. They were down, but let's be honest, not tremendously, only down 0.35%. That's another dividend aristocrat. They'll be looking towards splitting up their company here within the next year or so, so it's going to be interesting to see how things progress there. We also see that looks like Amgen was down just a touch today. That stock's been firming up pretty nicely here recently, so a rare down day for them. We see that Moderna was down 3.7% today, and I think they had a pretty strong day last week, if I'm not mistaken, so maybe just a little bit of profit taking there. Netflix shows up here in the middle, and they were down 1.7% in the normal market session. But maybe this would be a good time to talk about what's going on after hours tonight. That could very well be just equally as important as what happened in the normal session today, because Netflix is one of those hotly anticipated earnings reports that comes out. And they were out this afternoon, and they must have impressed Wall Street because that stock is just ramping to the upside. Let me pop on over here to the main part of the platform real quick, and let's go over to the trade tab and pop in Netflix. And as you can see, they ended the session at at $240.86. So call it $240, and then call it after hours $275. So they're trading higher by $35 per share after hours. That's a monstrous move for them. And that's going to take you back and basically get you up and over most of the resistance that will go back to last spring for Netflix. Many of you will recall that I think it was the first quarter report. Netflix absolutely plunged and kind of shocked everybody. Remember, that was back at a moment where we didn't necessarily know what 2022 was going to become. And so it was one of the big first kind of early movers from a mega cap perspective that absolutely got annihilated. They've actually stabilized a bit more over the summer compared to other stocks, perhaps because they had already taken their licks. They were down so significantly last early winter into spring, that maybe they were kind of out of the doghouse by the time all the other stocks were going into the doghouse. So this will provide a bit of hopefully buoyancy to the markets starting first thing in the morning, particularly the NASDAQ. Remember, that's where you're going to have the biggest impact on something like a Netflix. There were some other outperformers after hours as well. I did notice that UAL was up after hours. That's United Airlines. So apparently they had one of their best earnings reports in years, which, is maybe a little bit surprising. I haven't been doing a lot of flying, so I can't provide much in the way of any first-hand experience there, as I have done very little traveling during the last couple of years, especially during the COVID time period. But apparently, other people are out there spending their money, going on vacation, having fun. I'm living vicariously through you, so go out there, enjoy your lives. But United Airlines up nicely here after hours. They closed the normal session at $37.25. They're currently knocking on the door of $40 after hours. Another big mover that I noticed that reported earnings, Intuitive Surgical. Remember, this was a growth stock that had performed so admirably for so long. They were one of the preeminent growth stocks for about a decade or so. They've kind of cooled off here more recently over the past year, like a lot of growth stocks have naturally. But they're having a nice little snapback rally here today. They ended the normal session at 193, and they're trading after hours at 216. So that's going to be another strong, likely gap up that happens tomorrow morning. Another one that's associated with more NASDAQ stocks there as well. And then I'll throw in our last trade application example that I did with you guys. I guess it would have been on Thursday, the last time I did the video, and that is Adobe. That one's had a little bit of a slow start there for us, but some nice news hitting after hours for Adobe. They didn't report their earnings, but they came out with a guidance, an unexpected guidance announcement for future earnings. And apparently Wall Street was either impressed by that or at least wasn't scared to death about it the way that it may have been under more negative sentiment types of days. And so we went from looking at a small loss today of 52 cents on that to now down here on our trade that we're doing from Thursday's video, making about $900. So basically went from, losing a few dollars today to completely reversing that to the tune of $900. So we'll see if that holds. This is the type of market where I don't necessarily feel comfortable counting my chickens before they're hatched, but hopefully, let's all cross our fingers, Adobe sees some good vibrations into tomorrow morning's open as well, and that's another big stock on the NASDAQ. So as you can imagine, with all that information I just gave you, the NASDAQ is likely going to be trading up after hours. Let's take a look at the Qs. That is the ETF that tracks it, and you can see that the Qs closed today at about 271, and they're trading above 274 in the after hours session. So far so good there, but obviously a long ways to go before tomorrow morning's open. And remember, there'll be new companies reporting in the morning as well, which could completely offset the enthusiasm of this afternoon's reporters. So but at least we can say, hey, at least it's not a complete wipeout the way that perhaps we may have expected just a few weeks ago when sentiment was so lousy on Wall Street. We were all kind of left wondering if, there was just going to be sell-off day after sell-off day once earnings season started. And right now it's kind of feeling like the opposite. Maybe, the companies have done a good job managing expectations for Wall Street analysts, and they're kind of lowering their numbers along the way. And then when it comes time to actually report the true number, they've already kind of brought those expectations down, and therefore Wall Street can rejoice a little bit upon that. So we'll see. But right now, so far so good. Looking like that tomorrow morning could be a good day for tech stocks. Let's take a look at some charts. You can see here that let's pull up SPX. On the S&P 500, we were up 1.14% today. Real quick, I almost forgot. Breadth of numbers. 447 out of the 500 stocks on the S&P 500 were up today. So that's good for about an 89% hit rate. So again, it was one of those days where we started high. So if you look at the S&P 500 here, we gapped up. So this gray area you see right here is the pre-market session. So we gapped up to right here on the S&P 500 from yesterday's close, and that's a big move. It's like almost 2%. And then we spent the rest of the day going lower, but we didn't go all the way back to where we closed yesterday. So kind of a goofy day in that way where, you know, it felt like it should have been a much better day than it ultimately turned out to be. Yet when you look at the true breadth of numbers, most stocks did still have a positive performance today. So again, we'll take what we can get. All right, let's take a look at this chart 6D here. And remember, this chart will show us in a slightly different visual format what sorts of movements we are seeing either up or down and how erratic those movements are. And as you can probably imagine, we have more erratic movements once again here, with lots of these green bars going up from this black horizontal line and lots of those red bars stretching quite low below it. Whereas, you know, kind of maybe in this time period, notice, you know, in that July rally that we had in the stock market, that was kind of smooth sailing, really, you know, really since kind of middle of June to, you know, approximately the 16th of August. We had a pretty reasonably, quiet and calm rally in the market. And you can kind of see that in the length of these bars. They are not as exaggerated during this little stretch that I'm kind of circling with my mouse here. And then we move forward to the right, and you can see that these bars are much more exaggerated vertically, both up and down. And so today was another one of those 1% winning days. And my kind of the habit I had gotten into over the years was to display this chart whenever we had a 1% move up or down. But I kind of laugh about that now because 2022 is completely different from 2021, where the average day these days is likely a 1% move. In fact, you can see the daily range up here was only 76 points, and the average true range recently has been 92. So I had used to bring this chart up to your attention here to kind of show you kind of more exaggerated days, by showing you the bigger percentage movers, but I need to kind of move the goalposts apparently, because even a 1% day is a relatively calm day in the markets these days. But again, since it's to the bullish side of the equation, we'll take what we can get. You will see that the VIX remains elevated above 30 at this point. So we kind of topped out at the VIX here in this most recent run at about 33, and then have spent kind of the last week or so just meandering just a touch lower down to 30, but that is still considered elevated territory. You know, we've spent plenty of times over recent years with the VIX under 25. In fact, we spent a long time with the VIX under 20. And so it just goes to show there is still nerves in the air, and that shouldn't surprise any of you, right? We've had very little in the way of a true rally here. Yes, we're thankful that we've had 3 out of 4 days to the upside, but I doubt there's a whole lot of people that would say that that 3 out of 4 day move right there is a trend-changing move. Is it possible? Sure, we could always look back at any given moment in time and say that's where it started, but is anybody calling for that in real time right now? Probably a lot less likely, because odds are that it won't be. Could we get another multi-day or perhaps a couple of weeks rally? Of course. I'd like to see a strong winter and see seasonality come into play. But obviously the markets aren't going to listen to me. So we'll have to take whatever we can get. The truth of the matter is, when we look at this chart, we see lots of lower highs and lower lows. And so, you're fighting the trend if you're trying to take bullish trades to the upside. Now, if you're trying to buy long-term investments at more appropriate valuations than where they would have been a year ago, that's a different story, right? And earlier today, I taught my dividend growth investing class. We concentrated on the materials sector for our head-to-head matchup here today. So each week we do go hunting for long-term opportunities. But that's a different conversation than most of you that are watching this video as traders right now. You generally want to trade on the side of whatever trend is currently in place. And right now, the trend is still bearish. The posture might not always be bearish, but the trend most decidedly is. All right, let's go ahead and take a look at our foregrid. And as you can see here, our posture has changed. So on a few of these, not all of them, but on 3 out of our 4 charts, we do have what's known as a weekly bullish posture according to the market forecast technical indicator. So notice the background color change from dark pink to light green on the S&P 500, on the Dow Jones Industrial Average, and down below on the Russell 2000. I didn't get a chance to listen to David's video last night, but I'm sure he would have told you about the posture changes on the Russell and on the Dow, because that actually happened yesterday. Today, the S&P 500 followed suit, but notice that the NASDAQ is kind of trailing. It's not quite to that point. But again, after I just got done rattling off all those ticker symbols that were up after hours today, as long as those higher levels hold and the market is enthusiastic towards tech stocks tomorrow, I would venture to guess that the NASDAQ will indeed follow those other 3 and get their weekly bullish posture. Remember, all it requires is for this green line to get out of the lower reversal zone, and right now it's at 1960. So, it just have to go up 40 basis points to get out of there. And so that's almost a shoo-in to happen tomorrow if we have an update. Remember, what could happen is maybe the market gets really enthusiastic after a bunch of those numbers, gaps up tomorrow, and then spends the rest of the day selling off. So all bets are off if that happens. But otherwise, if we can hold gains tomorrow in the NASDAQ, it's almost a guarantee that you're going to be moving to a weekly bullish posture. Again, that doesn't mean that the trends are now bullish. It means that the posture is. Remember, there's different forms of posture as well. Weekly bullish is kind of obviously the weaker form of it, but if those moves hold and have more endurance to them, then they can eventually change into a strongly bullish posture, and that would occur once those green lines get above the chart's 50th percentile. None of these 4 charts are even remotely close to that yet. The one that is the closest and the one that's probably the most likely to do it, if it is going to happen, remember there's no guarantee that it will, but if it happens, right now it looks like it's the Dow Jones. That's our leader all of a sudden, right? I talked about that with you guys on Thursday, because it was on this candle right here that I was last with you, and I was saying how much closer we were to the moving average on the Dow than we were with the other indices. And now you can see the advantage of having that kind of prime spot, as it were, because if you can make a big move like we did on Thursday to get closer to the moving average, and that means any ensuing move after that gives you a greater likelihood of getting up and over the moving average. And so we actually can make that claim right now for the Dow Jones Industrial Average. And you'll notice that the same thing happened down below with the Russell 2000. So notice that those 30-day moving averages are yellow. The tips of them are yellow right now on those 2, whereas over here they're still red. The reason for that is all 4 of these charts have downward trending 30-day moving averages, but now we have price above downward trending moving averages on the Dow Jones and on the Russell. But of those 2, I think it's pretty clear at this moment that the Dow should be considered more powerful because it's more obviously above the moving average, whereas you'd have to really kind of squint to see how close it was. It might have been just a couple of pennies that the Russell 2000 was above the moving average there. You'll also notice that of the green line readings, the Russell 2000 is at 28 and rising, whereas the Dow Jones is at 32 and rising. Plus, given what I'd mentioned before in our discussion about the heat map with the banks kind of becoming a leadership group here in the last week or so, remember that caters much more to the Dow Jones than a lot of these other areas, because it's been the big banks that have been reporting, right? There are a ton of banks in the Russell 2000 as well, but the difference is they haven't reported their earnings yet. Who we've heard from are the big banks. The Russell 2000 is going to be those mid-cap small guys that might report a month from now. But, with the Dow, we've heard from, JP Morgan and Goldman Sachs, and that's going to have a bigger influence on the index at large. So right now, I'm pretty comfortable saying that if we're looking for a bullish leader in this market, it is the Dow Jones Industrial Average. Now keep in mind, that's not something that's necessarily good. If you want a really robust, strong, bullish rally to ensue, you'd like to see the most speculative areas take the leadership role. Those are the ones that can go up much more dramatically. But instead, we're kind of seeing the kind of boring old blue chip companies becoming the leaders here. Now, for me in my personal portfolio, I don't mind that as a dividend growth investor because, I own a lot of blue chips personally. But if you're asking me point blank, what would you like to see if you wanted to see a really strong bull market into the end of the year, then I would definitely not want the Dow Jones to be the leader. I would prefer to see the NASDAQ be the leader or maybe the Russell 2000. But, it's just not the market we're in right now. So we have to account for that. But, credit where credit is due. The Dow all of a sudden looks reasonable, right? You guys have heard me say for weeks that I'm more bearish than I am bullish right now in terms of my future expectations about the market. But my mind is flexible and I'm willing to change given enough evidence, as I hope we would all be, especially if we're viewing things from a trading perspective. And what I want to see is a lot of time spent above the 30-day moving average. And the markets have not been able to prove that to me for the last, let's call it 2 months or so. And so if we can get these 4 charts to start looking a little bit more like the Dow and then spend time up there more consistently, then maybe we can get a pretty solid rally coming out of this, right? You just never know what could be the catalyst, right? There's a lot of pessimism in the air, without a doubt. Sentiment is awful. Inflation's high, wars and geopolitical tensions and all this kind of stuff. So, there's a lot of people that are probably afraid to be long stocks right now, and that could very well end up being part of what fuels a rally. But there usually should be something a little bit more tangible in terms of a catalyst. It's just that the market can't predict what that is in advance in most cases. So you have to be willing to pivot if that day just shows up on your doorstep. So who knows? Maybe Russia, Ukraine, settles things, right? And maybe it's peacetime, and maybe that's what sends a shock wave through the markets. So you just have to be prepared. And I think a lot of you do a good job of that, because I think many of you who watch this video are very loyal to it, meaning that you are watching most days during the week. And so chances of you missing something major is probably not nearly as high as it would be for folks that just randomly check in every so often on their 401k account or something like that. So, those of you that watch this video more regularly and are more short-term trading, you should be picking up upon these clues. And if you're not by yourself during the day, then hopefully you're hearing from David and I at night as to what we are recognizing within the market. And of course, we're helping all of our premium members at Market Scholars with that throughout the trading day as well during our trading room. So many of you kind of have, a 1-2 punch where you're getting a couple of premium trading rooms from David and I during the trading day, and you're getting this free video at night. So you get multiple opportunities to kind of learn from us and hopefully gain some insight there as well. So to wrap things up, we've got 3 out of the 4 charts now with a weekly bullish posture. NASDAQ remains currently with a strongly bearish posture, but is in the driver's seat with a high likelihood that they will be going to a weekly bullish posture as soon as tomorrow. And in terms of who today's big winner was, it was pretty even today, quite honestly. They 3 out of these 4 charts were within just a couple basis points of each other. So you could say it was basically a 3-way tie between the S&P 500, the Dow, and the Russell 2000. S&P 500 was up 1.14%, Dow was up 1.12%, and the Russell 2000 was up 1.16%. So the Russell just barely got by the other 2 by a couple basis points. NASDAQ did lag. It was only up 0.9% here today. But again, tomorrow could be one of those days where the NASDAQ leads because of what we're learning after hours here tonight. Let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support David and I with this free video that you hear from us so regularly. Remember, it takes us about 3 hours, sometimes more, depending upon whether technology is working for us and all this kind of stuff. But it is a big commitment time-wise for a couple of business owners like us. And so each day we have to ask ourselves if it's time well spent and if those hours are valuable and justified. It won't be justified to us monetarily, but we're hoping that educationally for you, it is justified. And hopefully that earns us some goodwill along the way. And we ask and urge you to help support us by letting others on social media know about us, right? We are a very, very small organization, and therefore we recognized long ago that your guys' voice carries a lot further than just our two voices. And so we really appreciate those of you that interact with our various posts on social media, especially Twitter. That's the one that I pay attention to the most, since that's the one I'm on the most. And like I always say, as long as we're up and over 100 likes, then I think it's probably worth my time to do the video. If we're under 100 likes, then I get the sense that maybe my time could be better spent elsewhere. So you guys rarely let me down in that regard, so thank you to the 107 of you that did that for me on Thursday's video. And anytime we're up and over 100 likes, then I'll do a full-length video. And if we're below 100 likes, then I'll just do a quick little check-in that'll only be 15 minutes with no trade application examples. So this is another full-length video tonight, courtesy of all of you likers out there, including Ron and Roger and Lucius and Tammy and Brandon and Fun Jonesy and Charles and Art. We've got Tom and Norm and Scott and Jim and Ivan and Margie and Sonia and Tom, HR, Dennis, Eva, Lazy Boy Trader, John, AC, Adrian, Jayesh, Paul, Julie, Aviva, T-Fib, Sheila, Ayakipa, Dave, and others. Can't get through all of you, but I try to rattle off as many as I can in a minute or so there, so that way I can get your name in the light, so to speak, and just mostly send out my thanks to you. I appreciate each and every one of you that help us along with that. Also, while we're over here on the internet, let's take a gander at this sector selector tool. A reminder that this gets put together on Friday evenings, and so by the time I do this video here on Tuesday, we're a couple of days stale on it, but it still gives us a pretty good chance to look at what's been kind of going on from a sector perspective more recently. So for the third straight week, we do have energy up at the top. Oil and gas companies are the rare bright spot in this market when it comes to actual business operations. In fact, I heard a stat on, I think it was CNBC here recently, that said that earnings will still be up in 2022 versus where they were in 2021, but it is almost entirely due to the oil and gas companies. If you backed out the oil and gas companies, we would actually see profits fall year over year. So the energy companies are doing some heavy lifting right now, and stock market participants are somewhat rewarding that with higher than average or higher on a relative basis prices than the other sectors. You also found that the consumer staples made a nice little move back up to the number 2 position. Remember last week I was with you a couple of those days. We were talking about stocks like Pepsi as an example, coming out with their earnings and seeing that they had some pretty good pricing power there. So I'm sure that aided the consumer staples there a bit. Industrials fell one notch but remained in the top 4, and then healthcare made their way back up into the top 4 there. Remember, healthcare and consumer staples are a bit more defensive. And so, that could be just a natural kind of de-risking that we see taking place there more recently within the markets. And remember, again, that's not necessarily something that we want to see if we want to be bullish. I don't mind seeing energy up there, but we don't really want to see consumer staples as a leadership group in this market. We would much rather see technology or communications or discretionary leading the way. So we've got work to do in this market, no surprise there. But it's not an impossible task. So we've always got to be prepared. All right, let's go ahead and pop back on over to the to the platform, and let's do some 12 grid analysis. Starting with chart 5A, and this is our asset class 12 grid. Things are looking a little bit different here today, all of a sudden. Remember when I was with you last week, I was joking how it's the same old, same old. It was the bottom two corners that were the green charts and everything else was pretty much red. And one of those days, oil might have been up as well. But point being, things do look different here this week compared to what we were just looking at last week. And again, that's the point of looking at this stuff as often as we do, because things do change. In fact, we spent a really good amount of time in my dividend growth investing class earlier today talking about the changes of companies and the largest market cap companies on planet Earth from the year 2000 to 2022, and how tremendous the change has been just in the last 2 decades. Where once upon a time, of course, General Electric was by far and away the world's largest company, and today it's a bit of an afterthought. So things do change not only in the short term here during these videos for those of you that are traders, but things change for all of us long-term investors as well, and it's important to kind of stay plugged in and not just put your head in the sand like an ostrich if things aren't going the way that you want as an investor or a trader. So things are changing a little bit here. Let's at least acknowledge them. You can see that the 10-year Treasury yield down below in the lower right is the one thing that is not really changing all that much. It was down a touch today, but not a whole lot, and still remains basically at 4%. If we round it up, it's exactly at 4% right now. So a rare down day for it after 3 days to the upside on yields, but it was a bit of a whimper as far as it being a down day. That's another thing, that if you were asking me what would be on my wish list in terms of having a bull market emerge between now and the end of the year, it would be whatever it takes to get the darn Treasury yield down, because it's effectively just acting as a built-in block of resistance there, it seems like to me. In fact, we talked about that in my DGI class today, where the market was coming down, and I said, well, I bet it's probably because the Treasury yield is going back up. And sure enough, exactly during that class is when that was happening. And at that time, it had gotten up to 4.05%. So between that class, which was in the morning, and then the end of the day, it did cool off once again. But still, when we're flirting with 4% 10-year Treasury yields, that's quite a mighty attractive alternative to what money could otherwise be going into the stock market. Not only that, but the shorter term rates are even higher in some cases. Some of you saw my tweet here earlier today. For those of you that are Tommy Boy fans, that was a movie that I thought was hilarious in high school. So that ages me, I suppose. But anyway, did I catch a niner in there? And the niner that I was referring to is that only 9% of stocks in the S&P 500 right now have yields in excess of the 2-year Treasury yield, not the 10-year, the 2-year. So, some of those shorter term treasuries have even higher yields, and of course that's where we're getting the conversation of the inverted yield curve from. But you can see why stocks have a challenge right now. If market participants can invest in a bond for, let's say, 6 months and get 4% out of it and a guarantee they'll get all of their money back, many people are taking them up on that. And if that money is transitioning into the Treasury market, it's going away from the stock market in some cases. And if money is going away from the stock market, it means there's less demand for stocks, and all else being equal, stock prices go lower. So all that kind of is interconnected with one another. Now, in addition to the 10-year Treasury yield having a bullish posture, remember that's that darker green, so that's the strongly bullish posture. Notice that we've got 4 other charts on the board that are light green. So Bitcoin is light green, high yield bonds is light green, foreign stocks is light green, and as I already alluded to with the S&P 500, U.S. large caps are light green. So all of those are what we would refer to as weakly bullish. So they're not necessarily the types of charts that you want to take action on bullishly right now, unless you have a high amount of confidence things are going to continue into that direction. But it is a way to give you a heads up, is maybe the way to kind of think about it, right? And I think that should be obvious when you look at this chart down here in the lower right-hand corner. That's a beautiful chart. I wish it were an individual stock, but no, it's Treasury yields. That is a beautiful looking, strong chart. These other 4 that are in light green, none of those look like beautiful charts. But what they could be telling us is there's a start. and whether there's a finish to that start, we'll all find out together. But there's at least some bullishness finally entering into the system that you will want to pay attention to. It's giving you a heads up. Pay attention to it. You never know if 3 weeks from right now, those 4 charts start looking like this chart down here, right? It's got to start somewhere. So right now I have my hesitations because we remain below a lot of those moving averages, right? With the S&P 500, foreign developed stocks, high yield bonds, Bitcoin, they're all below their moving averages. And so until we can spend consistent amounts of time above those moving averages, like, a few weeks, I'm still going to have that paranoid feeling that we are in a very difficult market to make money in right now. And while every stock market needs to have healthy doses of both up moves and down moves, the main core move right now for the markets remains to the downside. So take that for what it's worth. All the rest of the charts on the board, as you can see, are pink. 2 of them are light pink, and that's oil and the US dollar. That should not be surprising, knowing that they were just both bullish last week. So remember, that's usually how it transitions. It usually doesn't go from strongly bullish to strongly bearish. There's usually, strongly bullish to weakly bearish, and then maybe it gets strongly bearish after that. Of those 2, the one that's most likely to go strongly bearish is probably oil, because if you look at that chart, it's a clearly defined pattern of lower highs and lower lows. With the US dollar, you can't really make that claim. Yes, it's fallen 3 out of the last 4 days when the stock market's been up 3 out of the last 4 days. I don't think that's a coincidence. So, it's the system kind of has to recognize there is a little bit of selling pressure here, a little bit of wear and tear, but we're still clearly above the rising 30-day moving average on the US dollar. So I'm not sure how much I'm going to trust that move until we spend more time below it, which certainly could be in the cards. I think, the US dollar has probably out-earned its potential this year. It's been one of the few things that's done quite well this year, and it's kind of been a thorn in the side for a lot of stock participants, those that have stocks in the commodity areas, those that have stocks that have big international exposures. So anyway, if the dollar can roll over, that would be, in my book, a bullish feature to the markets. But right now, I think we're premature in saying that it's actually rolling over until you spend time below that moving average right there. Long-term treasuries managed to go up today. Now, for those of you that are premium members, remember I've been managing our market outlook trades here, or I should say my market outlook trades. David manages his own, and then I manage my own. But we relay that information onto you guys through our private Telegram channel. And so I did roll the TLT sold put to a further out month. And right now we're not in the money, but because this particular ETF continues to go lower, which feels like day after day after day, it's one that I kind of feel like I need to babysit a bit more. I keep thinking to myself, there's got to be a more extended move off of the bottom for more than just a day, but obviously there's no guarantee that's going to happen. So you got to do your best to try to stay plugged in to not only placing trades, but also how do you maintain them and how do you manage those trades. That's in many ways equally as important. So it has been a tough go of things for the long bond here in all of 2022, but especially here just in the last 2.5 months. Foreign bonds also remain with a strongly bearish posture. They were up today as well, and they were both kind of up in that same general territory, about 20 basis points. You can see here that the foreign stocks from an emerging perspective do remain with a strongly bearish posture, even though their counterparts in the developed world are getting a little bit more bullish. But both of them remain below that falling 30-day moving average, so I'm not throwing any parades for either of them at this point. It's just that it seems like the developed world is doing a little bit better right now than the developing world. That can change pretty quickly, but right now you can see with your own 2 eyes that we're knocking our head up against the underside of that falling 30-day moving average on EFA, whereas we still have a pretty significant gap between where we're trading and the moving average on EEM. So just seems like the emerging markets have a lot more work to do from that perspective. Let's go ahead and now take a look at our sector 12 grid. This is chart 5C for those of you who are premium market scholars following along at home with your own charting package. All right, so as we kick this off, this also looks better, right? And it's funny how 3 out of 4 positive sessions can kind of start changing the picture for us, because it didn't look this way last week. But it is true that each additional up day that the market can provide to us, the better that the charts that make up the market can start to look as well. And so today was obviously a pretty positive day. All of these sectors closed in the green. It looks like the one that closed the least amount in the green, in other words, our laggard, would have been healthcare. And given what we saw there on the heat map of the S&P 500, that probably makes sense in my head. Remember, Johnson & Johnson and Amgen and a few of those were down today at maybe a slightly bigger percentage than we saw with the other sectors. So again, the average healthcare company was up today, but it just lagged the rest of the market. However, you do still see healthcare as a weekly bullish posture, and it is a rare sector, in fact the only other one other than energy, to have a green moving average, signifying price is currently above its 30-day moving average for healthcare XLV ETF. In terms of who our biggest mover was today, from a sector perspective, it probably would have been, right here, industrials had a nice day. We actually spent our time yesterday in my top-down trend trading class concentrating our efforts on the industrials sector. So we picked out a couple of industrials companies that were still showing strong trends. And so for those of you that might have participated in that class and purchased those companies, congratulations. Looks like industrials is helping the idea of the all boats rise with the tide concept that's out there, right? Whether that always works in practice is anybody's guess, but that's kind of what top-down trend traders are desiring when they're implementing their plan. The other thing I would say about industrials and them being up today, and remember, a big chunk of this could have been what I had mentioned before about Lockheed Martin, Northrop Grumman, General Dynamics. That was a big reason that the industrials likely outperformed other areas today. But the other thing I would mention is that we are up and over this kind of tiny resistance area here from the first week of October. I know that's probably hard for some of you to see if you have a smaller monitor, so let me maximize that cell and I'll show you what I mean. So notice that today I would have qualified this as a pretty important candle because we were able to break up and through the downward trending 30-day moving average. So now we reside on the other side of that. So that's a good sign. Not only that, but you can also see that we have pulled that green line out of the lower reversal zone with that move. That's an important takeaway. The other thing I would mention is that we closed near the highs of the day on XLI. I didn't even notice that earlier today. I'm just, seeing that alongside of you right now as I record this. I didn't realize that was the case because I just assumed most sectors were closing, near their lows of the day, yet still positive from yesterday's close. But that really doesn't define what we're looking at here with the industrials. We closed near the highs of the day for industrial. So this was kind of giving you the impression that it was picking up steam as the session was going along. And then last but not least, what I originally wanted to show you is that we are now up and over these two candles right here from October 4th and October 5th. And, not all sectors can make that claim. But, obviously we've got other resistance here and back here and back here and back here that we have to contend with. But hey, if you're going to have a massive reversal, it's got to start somewhere, and you got to start taking those resistance points out one by one, and we've just taken one out here. Let's see if it can hold, especially if it can hold above that moving average. I think that's a pretty reasonable sign there for the industrials. So I don't think there's a lot of people talking about industrials out there right now, but from what I can tell, they deserve to be talked about. Again, very few of these sector charts are trading above their moving averages. You could throw financials into that conversation, you could throw energy into that conversation, and healthcare into that conversation. And if I'm not mistaken, let me just go back to the internet again real quick. Energy, industrials, healthcare, financials. 4 out of the top 5 on the sector selector just happen to be those 4 that I just rattled off there a second ago that are trading above their moving averages. And remember, that graphic was produced last weekend, so it would not have known in advance that some of these were going to get over their moving averages as we kicked off trading the last couple of days here this week. So it's good to see that those two things are in conjunction because they are kind of measuring slightly different things. The sector selector uses an equal weighted approach. These charts you see in front of you are market cap weighted. And there's a different scoring mechanism where we're using a blended time period approach there on the sector selector with 1 month, 3 month, and 6 month inputs. These are just purely 3 month inputs that you're looking at in front of you here with these 12 grid charts. So, but it is good to see that they kind of confirm one another and give us, maybe a higher degree of confidence that those indeed are the leading areas of the market right now. In terms of the charts that are still in the red, it's discretionary, it's utilities, and it's real estate. Utilities and real estate are an interest rate story. Remember, those two are the most interest rate sensitive of all of these sectors. So they're the ones that are going to have the biggest challenge outperforming when interest rates are going up, as they have been for the last 2.5 months. And so you're kind of just seeing, a little bit of pop back the last couple of days, but still in a pretty difficult position trading-wise for those two areas. Discretionary is a little bit of a different story there. Discretionary could get some bounce tomorrow, perhaps with some of those more NASDAQ-oriented names doing a bit better. Remember that Amazon is obviously a discretionary stock that sells a lot of goods and services online. I saw, by the way, that Amazon is going to be offering a Black Friday football game next year. So that will be new. We are all used to seeing Thanksgiving football, but I guess next year we're also going to get a Black Friday football game because Amazon Prime is in the business of streaming NFL games these days. So a lot of folks know Amazon obviously as a retailer, but as a streaming video service, they compete directly against Netflix, and with Netflix flying higher today for the communications sector after hours, then maybe Amazon will get a shot in the arm tomorrow to kind of go up in sympathy with them. The other thing that's going to be big for discretionary is Tesla. I believe Tesla reports their earnings tomorrow, and it's probably after hours, so we might not see it in the normal session tomorrow, but those are a couple of things to be on the lookout for in terms of discretionary and whether they can kind of start joining some of the rest of these charts here in the green. All right, let's go ahead and get into our trade application example now. And I'm going to just pull up one of our swing trading charts, and I'm going to take a look here at chart MU. And for those of you following along at home, this is chart 3A here. Ticker symbol MU is for Micron Technology. Not necessarily the world's most popular semiconductor company, but an important one nonetheless, and one that is traded quite actively. And so those of us here in the United States, at least, should be familiar with it. As you can see here, Micron has had a tough go of things over the past 3 months of this chart, like so many other companies have. It's down about 17% over the last 3 months. You'll notice that there's this dotted gold line above the price candles, and that represents the pathway of the S&P 500 over the same time period to allow us to see that Micron is underperforming the market at large. So typically traders, when they see that, will be interested in more bearish trades. Obviously, there are exceptions to the rule, but in general, if you're going to do something bullish, you usually want to find something that is outperforming on a relative basis. If you're going to do something bearish, you're probably looking for something that is underperforming on a relative basis. And that fits kind of what the angle is for this trade that I've done here today. What I did was I sold a bear call spread. And I just went out to the month of November. I kind of debated between November and December because they're both kind of in that territory where it would be somewhat acceptable. Chose to go with the shorter term in this case. And I think what I did was I sold the 57.50 call and I bought the 60 call. And so that's known as a bear call spread. And what happens in that type of a trade is I receive a credit up front. And the driver of the trade is the sold strike, which is the 57.50, but our true kind of break-even point is up there slightly above 58, because if you build in how much you received in credit and then kind of add that to the sold strike, that's where your true break-even is. And that's approximately, somewhere in this general vicinity that I'm circling with my mouse right here, where I basically want Micron to stay below those crosshairs between now and the middle of November. Now, part of the reason I chose Micron is they are a little bit off cycle. I think I talked about that last week with Adobe as well. There's a handful of companies out there that aren't in the big mix of earnings with everybody else. Micron already reported their earnings in late September, meaning that the next time that they'll report is probably going to be late December. And so earnings will not, upset the apple cart on my trade. Not to say that it can't lose money, obviously it can, but it won't be earnings that does it to me. It will have to be something else that causes me to lose money on the trade. So that was certainly playing a role, is knowing that, hey, it's nice that this one won't have earnings during the time period of the trade. You'll also see that the background color of the chart is light pink, telling us that the near-term posture is bearish at this moment in time. You will also see, by the way, that the green line is at 47 and falling. So while you don't see it on the background colors here, if we used a different chart that focused more on the intermediate line, it would also be confirming strongly bearish posture for this one as more of a trend trade from an intermediate perspective, as opposed to the swing trade that I'm doing now, where I'm only going to be in a trade for the next few weeks. And then the last thing that I'll mention is we do have an example here of a bit of a bearish divergence that's taking place. Notice this peak in the blue line down below here at the end of September, and then you've got a follow-up peak here kind of in the first week of October, and then we have another peak right here on the 13th of October. And each one of those are successively lower, and therefore, if it's happening at a time when the price is rising, you could get away with saying that's more of a bearish divergence feel there. In other words, price is going up, and so people who are only looking at the end of day prices in the Wall Street Journal may think that things are going swimmingly, but what technicians may be seeing underneath the surface by looking at technical indicators is there's a little bit more bearishness under the system or under the hood than what price is accounting for so far. And the hope is that eventually price sees it the way that the underlying indicator does, and that price will follow suit for a bearish setup like this one. But it's not a dramatically directional trade. I just simply need it to go sideways, need it to roll over, or even go up a little bit, but just not go up dramatically above 58, and I should be able to make money with this trade. So that's what I had for you here tonight. Hope you got value out of it. If you did, I have one simple request out of you. It won't cost you a penny. All you have to do is take 5 seconds out of your day and click like for me there on Twitter. Remember, you can do that either on Twitter or in the description area of YouTube itself. You'll find the link to the tweet in question. You can also find the Twitter widget underneath the embedded video player on our website for those of you that watch the video there. And then you'll also be able to find the tweet in question with the Twitter icon on the emails that we send you that are on the distribution list that are out there. So 4 different ways to find the specific tweet to make it as easy as possible for you to complete that task. But as long as we're up and over 100 likes again by the time I'm scheduled to do this video on Thursday, I'll be happy to give you another full-length video like this one that's gone nearly an hour here tonight. If you don't want these longer form videos and you'd prefer just a 15-minute quick hitter, let me know what happened with the 4 indices type of a video with no trade application example, then don't click like. And if we're under 100 likes, then I'll just make sure it's a quick little video there for you on Thursday. So we'll let you decide through your likes. But as always, we really appreciate you checking out these videos. It means a lot to us. Hopefully it's valuable to you as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.